What's good, people? We're back again. It's Ash Assets, man. So today we're running through some basic stock market principles which you need to know and add into your investing game to truly maximize the way you navigate your journey. Okay, so look, let's get straight into it, man. So look, man, stocks and shares. We've all heard the term before. What they really mean, man. So stocks and shares are what make up a company. So take this as a company. Now the company will split into segments, into shares, okay? So stocks and shares are essentially the same thing, okay? So you've got your pie split into segments. So each of these segments represents a piece of the pie, it represents a share, okay? Now the fastest way that people in this country today and other countries out there, the fastest way people build their wealth is through the stock market. Now, I know we always hear about real estate and, people are going back and forth about stocks is better than real estate's better than stocks. Like, forget all that, man, because I'll be honest, anybody who demonizes and tries to outcast an asset class, that's a losing strategy, man. I'm good for everything, but I'm bringing stocks to you, and I started with stocks because it's the easiest way to get in the game and it's the fastest way to start building your net worth, man. So look, there's two main ways, there's two things that you need to build your wealth. Now, one of these things is equity. Now, if you don't know what equity is, it just means that you are an owner of something, okay? You have a stake in that said thing. And the second thing we need as well is cash flow, man. Because ultimately, we can't buy none of this if we ain't got no cash. So whether that's your paycheck, whatever's left over, if it's your business that's cash flowing, you know what I'm saying? So whether you've got rental income from real estate, whatever it is, you've got to create cash flow and ultimately use a portion of that cash flow, whatever percentage it is for you, whatever's comfortable for you, to put into your investments, man. Obviously, like today, we're talking about stocks. So we're going with stocks, okay? So yeah, like I said, stocks and shares represents your ownership, your equity in a business, okay? You got that, yeah? So we always say the first question, how do I start? What do I do? How do I get into the game? So there's three main ways you can get into the game, okay? Now I'm talking to the everyday 9-to-5 worker who's mainly going to be watching these videos. Now, if you're an entrepreneur, that's cool. This is for you as well. But obviously, to switch a few of these words around. So, first one, we're going to milk your 9-to-5. What I mean by that is absorb and utilize your income, your salary, your paycheck to the maximum potential. Now, I understand we've got bills, I understand we've got a mortgage, we've got that rent to pay, we've got to pay our baby mums, I understand all that. But what we need to do is really milk and understand how much of our income do we actually earn. I didn't say how much we earn, I said how much do we actually own. And that's for you to understand that because everyone's talking about, I ain't got no money left over, this, that, and the third. And I can empathize, it's cool. I know we're in a cost of living crisis and all that stuff. We've all been there. We all understand that. But truthfully, I ain't going to go too much into a rabbit hole, but truthfully, a lot of us, the majority of us, do have some cash left over after everything's said and done. And it's down to what you do with that cash that will determine your financial futures. So when I say milk your 9-to-5, it's truthfully utilizing the paycheck, your job, because that's ultimately the catalyst that's going to catapult you financially to the next step. You haven't got to quit your job to start a business and do all that stuff, man. You know what I'm saying? Like, I did it myself, work a 9-to-5 while building a business at the same time until it outweighs your 9-to-5 income. And even then, you don't have to quit. I know there's all this thing on social media about like quitting and being an entrepreneur, but entrepreneurship isn't for everybody. It's not for everybody, truthfully. So you can still be a 9-to-5 millionaire, man. I'll be real with you. You can do it. So that's the first thing, man. Understand what our paycheck, what our take-home pay, what our net pay is after everything's said and done, and it's what we do with that percentage that will determine how far we go financially. Okay. So number two, what you know. So that's a great way to start. What you know about. I say, I don't know what stocks to pick. Alright then, I challenge you to say like, how do you know about what's the hottest trend? What's the hottest this, that, and the third? The hottest gadget, the hottest technology thing? Like, all these things are investable. Over 70% of everything out there in the world is investable. So it's likely that something that you use and consume and love is probably investable. So you're able to put some of your money, your hard-earned money, into great things that you know about already. So I just challenged you there. So that's a great way to start getting into the game. Now the last one's a little bit more in depth. I'm going to break it down simple for you, man. So we're going to start with ETF. So that just means exchange traded funds, okay? So what's that, Ash? Said a lot of words, man. What's that really mean? So an exchange traded fund, just think of it like, okay, let's say you walk into a store, you want to go get some food, you want to go get a munch, but you don't really know what you want to get. You got a little idea about what you want to get, but you're feeling hungry. What an ETF is, you go into a specific aisle. In that aisle, you've got pretty much all the same kind of stuff. So whether it's the technology sector, you walk into the healthcare sector, you go into the industrial sector, you know what I'm saying? All these different sectors, all these different aisles, you grab one of everything, put it in your basket, scan it through the checkout, and you pay that one price. So that's what an ETF is in the most simplest form, okay? So I always say, one of my favorite sayings is like, we don't know where we're going if we don't know where we've been. Now, what I mean by that is like, we need to understand the fundamentals of economics and how money works in the stock market, okay? So look, cool. So first and foremost, we've got something called central banks. Now, there's a lot of them around the world. We've got Bank of England in the UK, we've got the Federal Reserve in America. So central banks, right, they're the big dogs. They're the ones that are really pulling the strings. They set the interest rates, okay? So they set the interest rates that regional banks give us. So, if in the UK, you've got your Barclays, you've got your Lloyds, you've got your NatWest, all them banks, right? They're regional banks. They're not the big dogs. They're the minnows. So the central banks set the interest rates that the regional banks charge us, okay? On our mortgages, on our credit cards, on our loans. They set that interest, all right? So when the interest rates start going up, which, in the world we're living in right now, what happens now is that our customer, being us, our spending power goes down. It weakens, and we naturally start spending less because we haven't got this surplus cash because interest is so high right now. And going to get a loan isn't as easy as it once was because the interest rate is just crazy right now, or getting a mortgage, better yet. So when our spending power weakens, okay, customers like us, like me and you, we take out less credit, less loans, less mortgages, because the affordability ain't there, okay? So when that happens now, customers ultimately who take out these loans, because it doesn't stop, obviously, nothing ever stops, it just slows down. So once we take those loans out, that lines of credit out, customers, again, we pay more interest on that credit, okay? We're paying way more interest for the same thing effectively, right? So what that causes now is a national decrease in disposable income, because remember we said, it doesn't stop, it just slows down. So if you take the UK now, 60 million plus people, nationally now, there's a decrease in spare cash, understandably, because we're paying back more credit, we're paying back more interest, on the same thing previously from before. So what happens now is that we've got less money to spend out there. Demand for goods and services out there, we're talking everything now, eating out, we're talking buying clothing, we're talking staying in hotels, going to spas, going to the cinemas, all these goods and services that once we were using before, we're not enjoying as many of them anymore, just naturally because we've got less disposable income, all right? Now, all these goods and services and things we used to enjoy, these are businesses that are on the stock market, okay? Over 70% of them are on the stock market. So now, because we're not utilizing and consuming as much as once before, what happens now is these businesses, they make less profit as a result. And when businesses make less profit, what happens now? The demand decreases and the stock price falls. That's how it works. That's how the money works in the stock market. Okay, it's not just numbers and electronic digits going up and down on a screen randomly. Now, that isn't just the only metric, but that's the overall view of what actually happens when it comes to the economic climate of the stock market. Okay, so look, man, again, there's also questions that there's always that rebuttal, and there's always people coming back to like, okay, explain to me why I need to invest in my money. Okay, and there's many ways I can back that home, but I like to use some data to demonstrate the reasons why you need to invest. Okay, because numbers don't lie, numbers can't be disputed. So look, why should we invest, man? Why should I put my money into things other than just sitting in a bank account? All right. So look, we've got things called large cap stocks on the market. Okay, so again, simply they're just the biggest, baddest companies on the market. You may have heard of the term the S&P 500. Now, what that is just the biggest and baddest 500 companies on the stock market. Okay, and the great thing about the S&P 500, I'll tell you, is that even if one business in the S&P stops performing and starts tripping, it's just messing about, the fund will just kick it out and replace it with a new one automatically. So that's why it's great, and it automates your investing for you. Okay, now I put some numbers on the side, best and worst. So best meaning the best year it had historically and the worst year it had historically. Okay, now the best year the S&P had was 32.5% more or less. Okay, on one of the years it generated 32% on your money. Tell me, is there any bank account out there that gives you 32%? Oh wait, now of course you can see the worst year was 37% and it's higher. You're going to think, okay, that doesn't seem like a good investment. They're both single years, and to give you more context, the stock market as a whole is up 76% of the time. Let me say that again. The stock market as a whole is up, it's in the green 76% of the time. So those are odds I want to be on the side of. Okay, so individual years, particularly when it's down, doesn't affect me because I know that 7 out of 10 years the market's going to go up and we're good. So that alone's a reason to invest your money. Okay, so look, we're going to keep moving through these. Okay, so small cap stocks, okay, so pretty much opposite to large cap stocks. Okay, now small cap stocks are just smaller businesses. Usually, they're coming out that infancy stage, they're just entering the market for the first few years, they've got smaller market caps. But what happens with that, they're more volatile. They go up and down in chunks, they go up and down much more rapidly. And with that though, is a good and a bad thing, because with that, the great thing is they can return a lot more money because of the volatility, and they have more growth ahead of them. Okay. Also, again, on the flip side, the downside is they can lose a lot as well. So again, we've got 38 and nearly 39% best year, which is incredible return. There's no bank account out there that's giving you that return. And of course, we've got the 34% down. Again, single years though. Again, overall, the green is good. Then we've got international stocks, man. As you can probably guess, it's what it says on the tin. Just businesses that are outside of typically your country. So let's say America now. Businesses that are outside America. Okay. Again, an amazing return, 32.5% on its best year. On its worst year, it was down 43%. Not too bad. Then we've got emerging markets. Okay, so emerging markets are your countries like your Indias. You've got the UAEs, you've got the Australias, Japan. These businesses, hyper growth acceleration, more exposure to new products coming into, because they're emerging, new technologies that are growing. Again, you see the return speaks for itself. On its best year, nearly 80% return, which is ridiculous on your money. Okay, and of course a big drop of 53% on its worst year. Okay, now we've got something called bonds as well. You may have heard that term before, bonds. Okay, so simply all a bond is you loaning your money to the government at a predetermined interest rate. So it's basically just like the UK saying, look, we're struggling right now. We'll lend your money off you. We'll pay you an interest rate and we'll pay you back when our P's come in. Okay, that's all a bond is, alright? And these are great because it's guaranteed though. It's guaranteed. It's like they will tell you exactly what percentage they're going to give you in what time frame. And it's a great way, and it's a hack, and it's a way to streamline your net worth. Once you're definitely of a higher level of net worth, you will see a lot of people putting their money, not all of it, but some of their money in bonds on the side as liquidity because they know they're going to get that 4 or 5% just fruit money sitting there doing nothing. You know what I'm saying? And when you're talking about 4 or 5% on a couple million, that's life-changing money, man, for doing nothing. So that's why bonds are great. And again, like you said, best year they had was 8.7%, worst year 13%. So look, at the moment, we don't need to really be messing with bonds too much because obviously, you know, they work better for when you've got more money, and also it's more risk adverse. So when you're older, people more chill out and put their money in bonds. So we don't really need to be, you know, exposed to that right now, but it's definitely keep it in your investing toolkit, man. And then lastly, we've got Treasury Bill Index, so it's just a fancy way of saying cash. So on its best year, cash returned 4.7%, okay? 5%-ish right now, on its best year. So if you do the maths now, I don't know about you, I'm not a mathematician or nothing, but all these returns are killing your money sitting in cash on any given of their best years. Okay? So that's, again, I'll give you more than multiple reasons why just sitting your money in cash is not the most effective thing, man. So, you know what I'm saying? This is definitely like, data can't be disputed. Like, I can give you my opinion and you can not agree with me, which is cool, but you know, you can go back, you know, and look at the data for yourself, go do your Googles, don't have to take my word for it. You know, these are reasons why we need to be putting our money to work harder for us, because we can't outwork our money, man. There's no one who's had 2 jobs doing better than someone with a single job, essentially, because you're just selling more of your time. You got to understand that money is time, it equates to time, and buying assets buys your time back slowly. Every share you buy, every share of the pie you buy of the company, more stocks you get, the quicker you get to your wealth. The more real estate buildings, the more real estate units you get, the more crypto you buy. You know what I'm saying? The more bonds you get, the more things you expose to these asset classes, you know, physical gold, the more things like that you get, the quicker you get towards your freedom goal. And everyone's freedom goal is different. It's not a number. Freedom is situational. So what will free you from having to part with your time? That's what we need to understand. Truthfully, we've got to ask ourselves some serious questions, man. So do you really want to build wealth? You know, because it's a question, it's a fair question. Do you really want to? Do you understand what it takes? Because I'll be honest, my freedom's the most expensive thing you acquire. And every day, you have to put a deposit down on freedom. You know what I'm saying? Like every day, you have to put a deposit down, and that doesn't have to necessarily be a monetary deposit. It can be, you know, a time deposit. You know, some kind of equity has to be given every single day towards your freedom journey. And a payment that's missed, you just got to double it up for the next day. That's why I said, do you really want to build up? Because you got to understand what it really entails, man. This ain't no easy feat. It will take everything from you. But once you get to the other side, you'll gain everything back and more. Okay? So what we have to do, very basic, very fundamental, but we have to save more than we spend. I know it's super simple, but not a lot of us can do that, okay? We aren't doing it right now. We can do it, we're just not doing it. We have to save more than we spend. Simple as that, okay? Now these numbers are relative to you. You need to understand what your numbers are, okay? After all said and done, if you've got a paycheck, you know, if it's 10%, is it 15%, if I've got 30% left, what am I doing with that 30%? Am I going to spend it? Am I going to go hit the bar? Am I going to go shisha lounge? You know what I'm saying? I'm going to go take another ting out for the weekend. What are you really, are these things servicing you to get further to your freedom goal? These are the questions you've got to ask yourself before you want to get into the game of building wealth. Next, once you get past this stage, once you master this bit, you have to invest more than you save. Okay? You have to invest more than you save. So like we said before, the numbers before prove that sitting money in cash isn't the most optimal thing. Now you need some cash on the side, some liquidity. You know what I'm saying? You need that on the side, but we need to understand that investing our money more than saving, because I'll be honest, and in investing our money, investing is like, it's like being a striker. A striker does what? It goes and bags goals. It goes and wins championships. It gets the ball in the back of the net. A saver is crucial, but all it can do is save. It can only be a goalkeeper. That's all it can do. It's crucial in the sense that it will block any financial, you know what I'm saying, pitfalls. That's what your goalkeeper does for you. It saves those financial bullets trying to hit the back of the net. But truthfully, the keeper can't do much more than that. You've never seen a keeper hit 30 goals in a season. You know what I'm saying? An investor, the striker, goes and bags the goals for you. So that's what we need to understand. We need our money to be doing, is hitting top bins, okay? So don't end on a light note. I want to end on the levels to freedom, because that's what we're all trying to get to. No matter what that looks like for us, we're all trying to get to that freedom goal and buy back as much time as we can, okay? So first and foremost, man, these are in order, but they're not linear, all right? And what I mean by that is in between these gaps, there could be half a decade to a decade in between, and that determination comes down to how fast you move between the two. But these are the steps, okay? So first and foremost, like we said before, we need to have these honest conversations with ourselves. We need to have the clarity. We need to figure out where we are financially in order to get to where we want to go. And without doing that, putting pen to pad and actually understanding how much of my money I actually own after I earn the money. And it's with that portion what we do will get us to the next step, okay? So number 2 is being self-sufficient, man. So once we've moved out of our dependent's household or parents' household, now this is, I want to say this as well, you don't have to do this, but this is just kind of eventually this will happen, okay? So I think personally the most optimal thing to do is stay at your parents' house if you're able to, and slowly build up over time. But you know, in the spirit of this example, we've moved out our parents, we've got self-sufficiency, and we can cover our expenses, okay? We can cover our bills. We haven't got to ring mum and dad every week to spot us 50. You know what I'm saying? We haven't got to do that. We're at self-sufficiency level, okay? People call it maturity, but it's just being self-sufficient. So next one, number 3, is a big one. And I've highlighted this because this is an amazing feeling once you reach this level. And I'll be honest, once majority of people reach this level, most of these aren't really needed for them. They don't really need, when they start getting into it and getting deeper, they don't really need this. It's this that they need. And this is the breathing room, that, you know what I'm saying? That fresh air, that breathing room where we're saving some money and we're no longer living paycheck to paycheck. Listen, man, ain't that good? Wouldn't that be a nice feeling where the money, you earn some dough and you're like, yo, I got some spare peas. I got some spare money. Like, that's a nice feeling. You know what I'm trying to say? So that's why we're gonna highlight this one, man. That's why we need that breathing room, man. After the breathing room, the big boy steps start happening, man. We get the stability. Now we have little to no debt, no consumer debt. Plus, it's big. Plus, 6 months of expenses saved in the bank for emergencies. Now we talk about that liquidity now. Now, 6 months, I use an extreme example because that's, you know what I'm saying, that's, I'm trying to get you to think wider and bigger to go forward, but that could be a couple of months. That can be, you know what I'm saying, a good couple of months that if an emergency hits, financially, we're good to go. You know what I'm saying? We can pattern that, move on, stack up and go again. Because we've got the what? We've got the stability to do so. So that's an amazing and important step. If the majority get here, listen, everyone be good, okay? So the next 3 steps are more advanced, and again, like I said, these are not linear. These may be big year gaps in between, depending on how fast you move through them. But number 5 is your flexibility. So now, you know what I'm saying, you're buying some serious time back for your life, and you can get to the point where you can take at least 2 years of expenses saved up. Not necessarily just sitting in the bank in cash, but you've got that kind of flexibility to, you know, it no longer becomes, I say this, once you're at that level, you no longer call it saving anymore. It's just having liquidity. So you've got your money sitting on the sideline to jump in and out of opportunities as you see fit, because you've got the what? You've got the flexibility to do so, yeah? So with that as well, if you wanted to, you can take the year off as well, because you got it like that. You know what I'm saying? Not that you would, especially if you're a business owner, that ain't really something you're going to do, but you've got the, you know what I'm saying? If you want to say, forget this, man, like, I'm taking the year off, you can. You've got that at your disposal, okay? So that's why flexibility is super important. Last two now, independence. Now, with this word gets thrown around a lot, but really and truly, this is an advanced step to have independence and truly understand what that really means. And what independence is that forget everything you're doing, just your investments, they can generate enough money for you to live off. Okay? That's what true independence is. It's like, okay, I still work, I've still got a corporate job, or I'm self-employed, or I've got my own business, I'm doing all that as well, but my investments can cover my lifestyle comfortably and they generate me enough income for me to do so. So I've got the independence to do so, all right? And then last one, man, last but not least, but everyone's birthright, and again, this should be, in my opinion, everyone's shooting goal. And again, it's not for everybody though, but it is your birthright, okay? And it's your abundance, man, because we need to understand that everything out there is of abundance, man, and there is no lack of money out there, okay? Once you start understanding what money really is and what it does, it's used to be a tool and a slave to you, and not the other way around. Money will go out there and multiply for you. It will sprout seeds and grow, and you know what I'm saying? Those money acorns will turn into money oak trees over time if you plant them in the correct place, and you also fertilize them with knowledge and execution and putting them into great assets. You'll have a whole field of oak trees, you know what I'm saying, sprouting money out for you, man. So money is abundant, and at that point then, it's no longer of a concern, okay? So that's the ultimate level of freedom, okay? And I understand it's not for everybody, but I believe it's everyone's birthright, man. Look, it's been your boy Ash Assets, man. Hope you've enjoyed, hope you took some value from it. Some simple principles which you can definitely add to your investing journey, your investing utility kit, and go out there, man, and take you from where you are financially to where you want to go to freedom, man. Let's go.